Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, how are you? Are you good? I always hope that you are good, stay safe and healthy. My name is Yosi Amelia Fitri. I'm a final year in the accounting department of Andalas University. In this occasion, I will explain you and present you my paper with the topic is the double sides of earning management as my final assignment on financial accounting seminar course. I hope you enjoy the video. Okay, this is the table of contents of the paper. In the chapter 1 is introduction that consists of background and a problem statement, and the second one is discussion that consists of definition of earning management, motives drive earning management, the techniques of earning management, and the fourth one is the earning management from the opportunistic and efficient point of view. The third one is conclusion, and the last one is references of the paper. Okay, we move to the introduction, chapter 1. The first one is background of the study. As the purpose of financial reporting is to deliver information to both internal and external stakeholders, it should be prepared in reliable manner, especially for earning, a primary part which is used as a basis to develop corporate policies and decision making. Ideally, its reported earnings should reflect the actual condition or actual economic performance of the company, which indicates the healthiness and firm's ability to maintain its going concern. Company is running by management, the party which investors entrusted their capital to. Given the control advantages in collecting and reporting the company's specific information over the external users, or usually call it as information asymmetry, when the one party has more information than another party, give them the opportunity to present earning in the manner it most suitable either for the company or for themselves. It's commonly known as earning management. Financial scandal at WorldCom and Enron has enforced the negative perspective of earning management is utilized opportunistically. It viewed that managers manage the earning for their own private benefit rather than benefit for stakeholder, which is managers use the information asymmetry to maximize their utility related to the compensation contracts. Nonetheless, a number of economic studies have argued that earning management might be beneficial because it potentially enhances the information value of earning. Empirical evidence is provided by Subramaniam in 1996 supported the contention of managers exercise discretion accounting to improve the ability of earning to reflect the economic value and predict future profit and dividend changes. From the perspective of efficient contracting, earning management is seen as a mechanism used by managers to protect themselves and the party in the company in anticipating unforeseen events for the benefits of the party involved in the contracts. It can be viewed that earning management has double sides. Either it's good or efficient, or maybe it's bad or opportunistic. Thus, this paper is aimed to distinguish between efficient and opportunistic use of earning management. And the next one is the problem statement of the paper. So, from the background, this paper is aimed to answer the following question. What is meant by earning management? What motives drive earning management? What are the techniques of earning management? and how is earning management from an opportunistic and efficient point of view. Okay, we move to the chapter 2, the discussion. The first one is, what is earning management? According to Scott 2015, the earning management is the choice by managers of accounting policies or real actions affecting earnings so as to achieve some specific reported earnings objective. From this definition, earning management includes both of accounting choices and real action. Choice of accounting policy refers to the choice of accounting policy per se, such as straight line versus declining balance amortization and policies for revenue recognition. And discretionary accruals, such as the provision of credit losses, warranty costs, inventory values, timing, and amounts of low persistent special items such as write-off and provision for restructuring. And from the Runen and Yari 2007, they classify and define the earning management into three: white earning management, gray earning management, and black earning management. White earning management is earning management when the action is to taking benefits from the flexibility, the choice of accounting treatment to signal the manager's private information on the future cash flow. And from gray earning management is choosing an accounting treatment that is either opportunistic to maximizing management utility or economically efficient. And for the black earning management is the practice to mispresent and reduce the transparency of financial report. And from Ghazali et al. 2015, it classify and define earning referred to GAAP boundary, which classify earning management into legitimate earning management and illegitimate earning management. Legitimate earning management is when if the earning management is done within the limit of GAAP, then it will be classified as a legitimate earning management. And however, if earning management practice go beyond the GAAP boundary, it will be classified as illegitimate earning management. And the next definition is provided by Haley and Wahlen in 1998, which is the earning management occurs when manager use judgment on financial accounting and in structuring transaction to alter financial report to either mislead some stakeholder about the underlying economic performance of the company or to influence the contractual outcome that depend on reported accounting number. This definition captures both the costly contracting approach, is the earning management is used to influence the contractual outcomes, and the informational approach, which is the earning management is used to mislead the stakeholder. This definition is also classify the terms of judgment, which in the nature of the accounting require the management to estimate some future economics as expected useful life or long-term asset and allocation for bad debt expense. And in addition, IFRS provides the diverse of acceptable accounting methods for same item, like the depreciation methods and inventory valuation method that can be used and choose by the manager. And we move to the motives of earning management. According to positive accounting theory hypothesis, there are three hypotheses that motivates the manager to do earning management. The first one is the bonus plan hypothesis, which is manager do earning management to maximize their bonus received. In the bonus contract, there are terms called boogie and cap. Boogie is the minimum level of earning to gain a bonus, and the cap is refers to the maximum level of earning. When the original earning is above cap, managers tend to decrease it and save it for the next future period. And when the earning below the boogie, therefore there are two possibilities of manipulation can be done. First, when profit is not too far from the boogie, then the manager may increase it to get a bonus. And second, if the earning is too far from boogie, the manager tends to decrease it and save it for the additional bonus in the next period, as long as the current earning is still positive. Furthermore, if earning is between boogie and cap, manager is tend to increase it to optimize the bonus they receive. And the second hypothesis is the debt confidence hypothesis. Earning management is due to prevent or to reduce the possibility of the debt violation. In the debt covenants, there are certain conditions that must be met by the company, such as pledging the assets or meeting certain financial ratios that indicates the company's financial health. Companies with the high debt ratio usually experience difficulties in obtaining additional funds from creditor. Even the companies are threatened within the violating debt covenants. As the consequences, it will face the accelerated debt maturity, increases in loan interest, and delivery guarantee, and difficulties in renegotiating of loan period. The closer the company to debt violation, the more managers tend to use the accounting procedure that can move future profit to the current profit, with the aim to reducing the possibility of the company experiencing debt violation. And the third one is the political cost hypothesis. Earning management is due to reduce the corporate tax and to make the company is less attractive by the government, media, and consumer. And we know that the amount of the tax is set progressively by the government, which encourages the company to carry out earning management by reducing reported net income to minimize the corporate taxes. As well as tax motivates, the company also do earning management by reducing their income, so they will not attract the attention and look less attractive for the government, media, and consumer, which might encourage the issuing of the new standard or the strict regulation. And other motives of earning management is provided by Scott, which is the first one is investor expectation. Manager do earning management to meet investor expectation. The matching of earning expected and earning reported help building up the share price, since it indicates the probabilities of future performance of the company. Firms that report earning greater than expected, or we call it as a positive surprise, positive earnings surprise, have enjoyed a share price increases, and as investors refresh upward their probabilities of good future performance of the company. Conversely, firms with negative earnings surprise suffer a significant share price decrease. As a result, managers have a strong incentive to ensure that earning expectations are met. And the second one is stock offering. Managers do earning management on IPO and CSEO to attract investor attention. On initial public offering or IPO and seasonal public offering or CO, financial reporting is being the primary information for the investor, especially the company's earning, because it will be used by investors to forecast the company's future performance. And so the manager will tend to do earning management to have a higher stock price due to positive response of investors who expect for good future performance. Or we simply say that managers do earning management to attract the investors to buy their share. And for the techniques of earning management, the first one is improper revenue recognition. Earning management is done by recognizing revenue early before the completing any performance obligation under the contract. This could be achieved by recording the future sales at the last day of the current period to boost the earning, while supposedly revenue is recognized when the entity satisfies the performance obligations of the contract, in keeping with the IFRS number 15 about the revenues from contract with customer. And the second one is the big bet. Big bet is an earning management where the company manipulate the income in bad year to look even worse than it actually is. So the upcoming period looks better and make the future performance look attractive. And the third one is income smoothing. Income smoothing is a component of earning management that is to that creates the growth of earning consistently, which might be healthy for the company's financial image. It's done by using discretionary accrual to minimize the variability of the published earning over the time. Income smoothing is taking place as a response to the users of financial statement concern on the fluctuation level of the earning, since it indicates the degree of persistence in the company's earning and sometimes it hints the bankruptcy risk. And the fourth one is cookie jar reserves. Cookie jar reserves is a kind of flip side from the improper revenue recognition, which is this strategy for manager to manipulate earning by aggressively accrual of expenses in which the company has a good result in the current period and the result from the following year are uncertain. And the fifth one is the big bet of the future. Big bet of the future is the technique commonly used after acquiring another company. So, manager may take advantages of the acquisition by writing off the research and development costs, as well as integrating the earning of the acquired company into consolidated financial statement that lead to the higher integrated earning. And the next one is introducing the new standard. Mostly it takes 2 or 3 years to apply the standard that it turn the company to change the published earning. Therefore, manager might be engaged in legitimate earning management practice through early or late adoption or application of this standard. And the next one is the depreciation, amortization, and depletion. It involves the management's discretionary judgment on selecting the write-off methods and the periods, such as the changing of the estimation methods of salvage values or changes of the asset classes or use. And the next one is early retirement of debt. It involves the manager judgment in selection of accounting period, retire debt for the purpose of utilizing any gain or loss on early retirement. It includes the retirement of long-term bonds issued by the corporate debt, for the corporate debt for the swap, or the debt for equity swap. And number 9 is flashing to asset portfolio. In most accounting standards require the investment to be classified either held for trading or available for sale, and any changes in value is recorded in the income statement. This technique involves the manager's judgment in deciding the holding intent, timing of sales, and a writing down of impaired investment. And for the operating versus non-operating, investor and financial analysts use the core or operating earning of the company to project the future growth, not the non-operating income. So this technique involves use the management judgment in identifying and reporting items that are operating or non-operating. For example, items like unusual, special charge, or extraordinary gains or losses. And the next one is the sales leaseback and asset exchange. It involves the management decision in outright sales assets to get more revenue in certain period. Sell and leaseback of same asset to get some revenue and exchange of similar productive asset without recognition of any gain or loss. And the next one is shrink to shape. It involves the company repurchasing its own share without reporting any gain or loss in their financial statement, with objective is to increase the company's earning per share. And the next one is the throw out a problem child. It involves the manager judgment to dispose a subsidiary when the group's earnings are dragged down by non or less performing subsidiary, with the purpose of saving or improving group financial result. Action takes might include the outright dispose of subsidiary, spinning off the subsidiary, creating the special purpose entity or SPE for financial asset and equity exchange. And the last one is use of derivatives. As derivatives are financial instruments that derive their value from the other asset, managers use them as a technique to manage their earnings by hedging against the future business risk, like the fluctuation in exchange rates, the prices change, and the commodity scarcity. Okay, we move to the fourth or the last discussion topic is the double side or the earning management from the opportunistic and the efficient point of view. Efficient earning management. From the perspective of efficient contract in positive accounting theory, The level of earning management can be considered good because it can improve the contract efficiency. And efficient contracts provide the flexibility in the ability of manager to manage the profits in a rigid or incomplete contracts. In his book, Scott in 2015 notes that efficient contracts assume that earning management can be used to facilitate the internal control and decision making. Efficient contracts that can be facilitated include the monitoring process of manager, limiting the manager's opportunistic behavior, minimizing taxes that must be paid by the company, reducing the cost debt contracts, and minimizing the contract costs. Efficient contracts are designed by considering the expectation of principal and lender for the opportunistic behavior of the manager, by incorporating the anticipated impact of the manager's opportunistic behavior into the contract. In this condition, earning management can be used as a tool for manager to strengthen the contract efficiency or to improve the contract efficiency. And the second one, as a signaling mechanism to facilitate efficient communication. From the point of view of signaling theory, the phenomenon of the earning management is a form of behavior in which a manager will manage the earning to disclose internal information related to the company's prospect that will function as a process of providing information to the market, or we call it as a signaling mechanism. With this earning management, the manager might be able to influence the prices through the creates smooth profit and growth over time. Research conducted by et al. 2020 and Subramanyam and 1996 and has documented the evidence the use of earning management as a signaling mechanism to facilitate efficient communication between the manager and the users of information. The signal provided through earning management are used to increase the value relevance of financial reporting and strengthen the ability of investors to predict the company performance. From the opportunistic earning management. From the contract perspective, opportunistic earning management can be identified through the tendency of the manager to use earning management to maximize their bonus. Opportunistic behavior and earning management has the point of view that manager use information asymmetry between external and internal parties of the company to maximizing their utility related to the compensation contract, debt contract, and regulation. Investors are then deceived by reports and unreliable information. Regarding the positive accounting theory, the opportunistic side of earning management illustrates the manager's desire to influence the transfer of welfare between the parties parties bound in the contracts. In a contractual relationship, the manager is a party that is most risk averse than other parties. So the subject has a limitation in the contract. So the manager will try to maximize his or their personal welfare. Okay, we come to the conclusion of the paper. The conclusion of the paper. The first one, earning management encompasses the selection of accounting and estimates conform to the standard. The presence of the asymmetry information provide the opportunity to the manager to do an earning management. An earning management practice usually motivated by several factors such as a bonus, debt covenant, political costs, investor expectation, and stock offering. And to do earning management, managers should usually follow some patterns such as big bet, cookie jar research, a big bet in the future, and much more techniques. And from the effect, we can see that earning management can be seen from the two perspectives. The opportunistic one, or to maximizing the bonus, and the efficient one, to boost the contract efficiency or cyclic mechanism. Although the earning management practice is disclosed and follow the accounting standard, but an aggressive earning management practice could be considered as fraud and reduce the relevancy and the reliability of the financial reporting, which might mislead financial accounting users about the firm's operating performance. Therefore, to reduce the impact of bad earning management practice, the management or the manager should improve their disclosure on adopted accounting policies, measure discretionary accrual, and the effect of write-off the core of the earning, because improve the disclosure will not only make it easier in assessing the management stewardship, but it also improve the share price to reflect the firm's value, promote the good corporate governance, as well as improve the firm's social responsibility. Okay, that's all from me. Thank you for watching. Thank you for your attention. I hope you get some benefit from the presentation that I do. And see you. Assalamualaikum warahmatullahi wabarakatuh.